Yes, welcome everybody. Welcome to this online panel discussions, tokenization of investment funds. My name is Benjamin Schaub. I'm a partner at Interstech, which is a consultancy specialized on blockchain digital assets. With me today is Simon Seiter from Hauck Aufhäuser Lampe, Martin Eckert from Everlabs, and Javier Garcia Nonay from Intellect EU. Together, we would like to discuss the tokenization of investment funds. We would like to cover firstly the regulatory perspective. Then we would also like to discuss use cases that we currently see, as well as the IT perspective, challenges here maybe. And at the end also, we would like to cover the business perspective in terms of can blockchain technology help in terms of opening up new distribution channels, and can the technology also help to realize efficiency gains when it comes to the fund tokenization. Before we kick off, I'd like to everyone to briefly introduce themselves to the audience, and afterwards we will set the scene and start with the first set of questions. Simon, please, maybe you go ahead and introduce yourself briefly.
Yeah, many thanks, Benjamin. So Simon, I'm head of digital assets at Hauck Aufhäuser Lampe. Been there now for 2.5 years, roughly. Before I had the same role at Deutsche Börse Group and already did some capital market transactions in the blockchain space at Commerzbank before. At Hauck Aufhäuser Lampe, we have been quite active in the fund space also with regards to blockchain technology and also crypto assets in general. We have 2 daughter companies in the digital asset space. One is a regulated banco, so we are also issuing funds that invest in crypto assets, which is not the topic as of today, but it's closely connected, let's put it like that. Then we have a fully regulated crypto custodian in Germany. And we also have, and this is maybe more relevant here, the so-called crypto security register preliminary license regulated by BaFin, which enables us to, in Asterix, tokenize both securities and also fund shares. And we have, as one of the largest also depositories in Germany, taken here huge preparations already and investigated in how far we can process these crypto fund shares.
Thank you, Simon. Maybe Martin, you go next.
Yes, thank you very much for having me today. I'm Martin from Everlabs, head of developer relations, and focus on the technical aspects of onboarding many institutions into the Avalanche ecosystem. Avalanche is a multi-chain ecosystem, so not a single blockchain. We do many different kinds of blockchains for different verticals: gaming, traditional finance, governments, and yeah, so our belief is that we will go to, like, the requirements of many industries are very different, and we need a very, like a single chain won't be able to fulfill them all. So we provide this network of interoperable blockchains that then can, like, still interact with each other in a trusted way, without, but keeping a shared core, but also providing, the ability to fulfill individual requirements.
Thank you, Martin. Then Javier, last but not least.
Thank you, Benjamin. First of all, thank you for inviting me to this wonderful panel. I'm Javier Garcia. I am leading digital assets at Intellect EU. We are a company that focuses on financial modernization, basically on capital markets and payments. My background is mostly on consulting and investment banking, and I have been working with different blockchain projects for around 3-4 years. Where we have been able to tokenize mostly all the financial assets that you can even imagine. And I'm just really eager to kind of like start this conversation and understand what it's bringing us this panel today.
Thank you. So yes, let's get started. At the beginning, we would like to briefly touch regulation, because at the end, this paves the way for all use cases. And here, in the last couple of years, we've seen in the European Union, especially in Germany, but also Luxembourg, when we talk about major fund jurisdictions, that regulators have created clear rules when it comes to the tokenization of fund units. In Germany, for example, Simon, you just mentioned, we have the so-called Electronic Securities Act, which allows the issuance of a tokenized security without the global certificate and without the central securities depository. You can do so for a bond, for a stock, also for fund units, But the important part is you need then to go via a so-called crypto securities registrar. It's a new license. We're glad to have you here because, as you said, Haug Aufhäuser-Lampe has one of these licenses in the grandfathering. This means you could actually maintain such a registry also when it comes to fund units. The nuance in Germany is that typically this registry would need to be maintained by the depository, who needs to have such a license, or the depository can appoint an entity who has such a license. But this is the way to go for fund units in Germany. In Luxembourg, we have seen several amendments of existing law to essentially get tokenized securities under the MiFID roof, the MiFID label, but also, and this is the important part regarding fund units in Luxembourg, the CSSF has issued a circular where they say UCI administrators performing the registrar function may use DLT to maintain the shareholder register. So issuance on DLT is allowed for all types of investment funds in Luxembourg. And when we prepared for this panel, we already concluded that when we look at the regulatory landscape, there isn't really missing something, and there isn't something everyone's waiting for from a regulatory perspective to enable tokenization here, essentially. And then we would like to talk about first examples. In Germany, we have seen Metzler, for example, at the end of last year, who issued a tokenized fund together with the crypto securities registrar Cashlink and with the settlement platform Funds on Chain. We've seen in Luxembourg recently that there has been a first tokenized share class, fund share class by Hamilton Lane, together with Apex, who would like to distribute their fund units to Signum clients. So we see there's traction in the market. Maybe looking in your direction, Simon, as you can really maintain such a registry, how do you observe the market? What are you dealing with? And how do you see the topic in general?
Yeah, we had quite some requests already early on, to be honest. So even beginning of last year, we had first discussions in this direction with potential clients. And I think that what you can see is, if you compare it, especially to the security side, because we had already some transactions with regards to securities on the blockchain, but even before also the law on electronic securities in Germany, but we had before and also now less transactions with funds on blockchain. And I think the reason is in general that funds or fund shares are, to be honest, a bit more complex than a plain vanilla security. And so trying it out is just more complicated. And if you want to do a transaction where you just try it out, let's put it like that, you need this kind of very closed environment right now, as it was very well done by Metzler, yeah. But it's a closed shop transaction fully. And we had this clients that asked us, as we are also currently a depository that is quite relevant, to be honest, for the fund side. We have the third largest depository for real asset funds, for example, in Germany. And so real assets being, for example, a very good example of fund shares that could be tokenized, so to say, to tokenize real estate. Yeah. We see that there is demand, but if you really want to put up transactions, it involves a lot of parties. It gets quite complicated, and as you described before, and where we also talk about the distribution especially is right now the driver. And then, of course, the expectations of efficiency gains, which will not be there in the beginning. And what we also saw is then it gets quite complex in the details because the product is more complicated. So you mentioned before you don't have the central security depository, the CSD. I used to work for the CSD, so I know this pretty well. This is, to some extent, can be an advantage, but to be honest, for secondary market liquidity and access to clients, it's a disadvantage at first that it's not with the CSD, because with the CSD comes the connectivity to all the depositories. And if you don't have that and the depositories are not ready yet to manage access to a chain, to a blockchain, then this means that you have to connect it individually. And so you lack the connectivity, and thereby you limit your size of investors or your scope of investors. And this is right now, to be honest, an issue where I think is also one of the reasons why it doesn't kick off, because you think you can distribute better and you have higher efficiency gains. And to be honest, I'm convinced of that in the long run. But again, as always, in the short run, both is not true, even the contrary. You have less access to distribution channels, and you have higher costs of doing business right now for the beginning on. And so you have to have this, as I said before, this closed shop environment to try it out, or you have to have, let's say, alliance of the willing partners that are willing to do it despite all these disadvantages. And there are still people in the market that want to do it, which is good. But on the other hand, I think if you look at the possibilities that are there with more automated issuances, higher individualized funds that you can even like really issue for individual investors, these are really big advantages on the long term. But we just started. So I think also expectation management is important. Yes, it's still a very, very, very early market, much more earlier than the security side, which is also taking its time. So we should give it some time to develop.
Thank you. Yeah, Simon, we will try to cover topic by topic now to really dive a little bit deeper in the issues you mentioned, or let's say hurdles you see currently, because you already said long term you're quite optimistic here in terms of tokenization of investment funds. Javier, Martin, something to add from your end if you look at current use cases of investment funds, something you want to share?
I think just in general, we will have to look. I think the entire financial industry is moving in the right direction, right? Like tokenization of all kinds of financial products is getting more and more popular. We see major player like JP Morgan and Citibank playing around. Like there was the program of JP Morgan, a test program, a pilot program with the Singaporean Monetary Authority, where they tested out something with Project Guardian. So there's a lot moving, but I do share the view that we are still early. There's a lot to figure out here, especially on the investment fund side. There are challenges that need to be solved over the next years. I think the efficiency gains that really comes into play with broader, like companies building out the knowledge, companies building out the infrastructure. So not every project, right? Like we see right now, I would say more these these moves that are, like more symbolic, right? Like a single, like very small number of assets getting tokenized on, a chain like Ethereum, and it's more a symbolic move. But they are huge projects, it's are profitable, I believe. And I think with further adoption, I hope we will get to a place where the infrastructure is in place and all this gets much, much easier across different asset classes.
Yeah, thank you, Martin. Javier, you want to add something?
Yes, I want to kind of like touch base on two different points that have been discussed right now. One is around the potentially or the potential liquidity or efficiency gains that we will get with tokenized funds on a DLT. And I want to really highlight the potential because one of the things that we have seen also on the other securities, some previous examples where banks started tokenizing different bond classes and different securities, we have started to see that tokenization was going to bring higher liquidity because all the benefits of doing this on a blockchain, but they all ended up tokenizing something in a closed shop, in a silo, just hindering liquidity at the end of the day. So that is a really, really important thing that is kind of like related to what Simon was saying around CSDs. And I really believe that CSDs play a really, really important role here, because at the end of the day, they are creating, or they should be creating, the market infrastructure for all these products to have essential real liquidity across all investors or issuers, asset managers, everyone, and make sure that there is a common place, there's a common shop for everyone to just go there and find what they really want to invest on. That's the first one. And the second one is more related to the different use cases that are happening right now on the market. And I've seen that Martin kind of like explicitly talked about the use cases with JPM and Citi. And I really believe these use cases are very, very important because they are just trying to make sure that all the benefits from smart contracts, from using a blockchain, are really benefits. And it's really, really interesting to see how these big players are starting to use smart contracts to automate portfolio rebalancing, to automate portfolios allocation. I recall that I think it was last week, in DTCC and Chainlink, they just announced a new way of how to put NAV into the blockchain, right? So using kind of like their technology for oracles, like how to introduce prices into the blockchain. And that really is going to bring a lot of use cases in the future. But again, and to just not repeat myself to what my colleagues are saying, we are in a very nascent kind of like market. And the really cool thing about it is that the blockchain exercise with tokenized securities started with a very efficient market, which is fixed income, right? And it's kind of interesting that everyone wanted to kind of like use blockchain for a very efficient market. Why not we use this technology with a market that as of now is very unstructured? And this is the fund market, right? It's very unstructured. There's a lot of manual work there. This is not efficient. Right? There are many players there. So I really believe that there's a lot of power in bringing fund shares into the blockchain, but we really need to go step by step and learn from what we have from previous examples in the past and try not to just have the same mistakes they did in the past.
Thank you. So yes, as you all outlined, there's a lot of activity. Yeah, we can see various market participants at least trying stuff out. However, we say it's early and things could be better. So firstly here, we would like to talk a bit about the IT perspective, right? We have the discussion in the not only the blockchain bubble, but in the financial industry of public versus permissioned blockchains currently. This is a topic that has been brought up by the Basel Committee on Banking Supervision, which essentially create two groups for crypto asset. And a crypto asset, according to Basel, is could be a Bitcoin, could be a stable coin like Circle, but it's also a tokenized traditional asset like a bond, stock, or a fund unit. And what Basel essentially does is they say if you fall under group 1, you have the same capital requirements as today. Yeah, there's nothing new about it. But if you fall under group 2, you would have at least 100% or even worse, 12.5x capital charges that would be required. Why are we mentioning this? Because Basel says if you use a public blockchain for the tokenization of a traditional asset, you automatically fall within group 2, triggering these capital requirements. Now, just recently, a Basel committee has announced that they will delay the implementation of those rules until January 2026. So they delayed it for a year. There is definitely a reason to argue this because there are other voices in the market who say that this does not make too much sense. However, from what we observe is this creates uncertainty, be it on the issuer level, be it on the market participant level that try to implement technical solutions. I would be very interested here in your views. Maybe Martin, you kick off and then we hear Simon and Javier.
Yeah. More than happy to. I mentioned already in the beginning that Avalanche is a multi-chain network, so we don't see permissionless permissioned as black or white, right? Like we believe that in the future we won't be able to create a single chain that fulfills all these requirements, may they be regulatory, may they be technical, across the globe, right? We have many different jurisdictions, and so I think the first thing we have to talk about is what does permissioning even mean? Right? What is a permissioned blockchain? And what we believe is there is permissioning on different levels, right? Like, so for example, with an Avalanche blockchain, there can be permissioning on the validator level, meaning, right, not everyone can, like permissionlessly validate the blockchain, and basically, so we can permission that. Basically, whoever controls the validators, has some, can control the blockchain and the state and can, implement whatever. There's also a different level of permissioning where we have a permissionless validation, right? Like, so we can move the trust to a collective instead of trusting a single institution, but we do implement on the chain level, let's say, like a KYC permissioning. So people that are interacting with the blockchain, we only allow people that went through some KYC process through a provider, right, or a set of providers to interact with the blockchain. So all the people are known. Still, we don't have to trust a single institution in running that blockchain. And we can still be sure whatever we do on this blockchain, even though everyone is known, we can comply to certain regulations like KYC regulations. We can still have these unique properties of a blockchain, even though we don't have this completely permissionless access, maybe. And then the what kind of like comes into the mix there is we also have a third level of permissioning and who can provide services on blockchains, right? So maybe we allow even everyone to interact with it, but we restrict who can deploy smart contracts, right? Like, so let's say, we want to create a permission setting that is compliant with local laws. We might want to implement KYC or don't. But what we definitely want to do is we want to make sure that no one just comes along and on that blockchain deploy something like Tornado Cash, which is far outside of regulatory, like the regulation in many countries. So I think like it's really important to understand like the different levels of permissioning. And what I hope, as I said, we are multi-chain network. I hope that in the future or in the near-term future, we will see, like many blockchains that can interoperate with each other. Some may be very permissioned on the validator level, on the user level. Some may be, like a mix of it, permissionless on the validator level, but permissioned on the user level and on the smart contract deployer level, but all of them being interoperable. So we can find ways to not, like build this permission silos that we have in the financial industry today. And so I do think it's not black or white. We need to find stepping stones. Obviously, like if it was up to me personally, I'd love to see a world where we're going towards, like a transparent, permissionless world. Transparent is maybe not transparent, but definitely a permissionless and decentralized world for the financial industry. But I do believe we will need stepping stones on the way, and we won't be able to do this wall, like coming from closed off Web2 silos to a complete transparent blockchain world in just a few years.
Yeah, thanks, Martin. Maybe Simon, here looking in your direction, right? As you can maintain such services from a financial institution perspective. I know that you have been used Polygon, for example, when it comes to the issuance or maintenance of such a registry. Of course, only what you are allowed to share, right? But how is this what comes from Basel influencing you from a technical perspective, maybe? Is it influencing you at all? What's your take here?
I think that this should not influence us, but we should influence the Basel Committee here. Their standoff point is, I think, wrong, to put it very bluntly. It's a nonsense regulation like that, because you say basically that a crypto fund share that is issued on Polygon has the same risk profile as a public Bitcoin. And this is simply from a factual matter bullshit. So, and it's not any harm that they do directly. I think they have people that have lobbied in these groups with intentions to save business because they can operate better their central structures on permission chains. And for that reason, they lobbied this inside. And it is simply far away from what is realistic and a fact. So we have decided to do everything on public because we will believe that this will give the true access and also is the only way of decentralization. I have personally advocated, to be honest, for years for permission chains. I have personally built use cases since 2017, really lots of use cases in different projects on permissioned infrastructure. And after years, I had to realize the idea is nice. And it's also nice to see that you have an architecture that is more designed for permissions, which in an environment that is compliant is always necessary. You need to know whom is behind the transaction. That is important, but that can also be ensured with a bit more effort on a public chain. But the private permission chain, or also even if it's public permission chain, maybe, it's never like centralized, decentralized enough. That's my stance. Yeah, and for that reason, we decided consciously to go on public, and we will also stay on public. We will not move back. It's like you buy an electric car and go back to buying a burning engine. It doesn't make sense. Or having an iPhone and going back to BlackBerry. It's a step behind. It doesn't make sense. So for that reason, we will stay public, and we will heavily advise through the possibilities that we have that the Basel Committee is here on the wrong path, and has to get a better impression of what it means to have a registrar. And it's also counterfeiting the German regulation, to be honest. Yeah. The German regulator with BaFin, strictest regulator maybe within whole Europe, is setting up a regulatory regime with the German Ministry of Finance that ensures transaction stability through such a role of a crypto security registrar. And then you're basically saying it, guys, you have the same quality level as a miner on the Bitcoin blockchain because it's the same risk profile. That's also bullshit. Yeah, then you wouldn't need the registry. So out of this perspective, I think it's clear. To be fair, you can, for example, do the 2.5% technology surcharge on the capital. Yeah, this is something that is, to be fair, I think okay for the short term. Yeah, but the 1,250% are completely out of range and undiscussable.
Yeah, I agree here. And Simon, I think the relevant point really is, right, we have this license in Germany, and at the end, it's about liability, right? And if you perform this function in capital markets, and if you fail to do so, then you're liable, right? It doesn't depend whether it's public permissioned or whatever, right? It's what you have simply to fulfill. Javier, looking in your direction, something to add here on this question, or?
Yes, just to give more of an overview of why this is important, because Simon was referring to the capital surcharge of 12.50% of risk-weighted assets. Just for everyone to understand, what Basel is saying is that for every euro that you have invested on a tokenized security on a permissionless network, you need to provision that same euro for capital calculations. So that is a clear no-go, right, for institutions to say, I don't really want to have these assets on my balance sheet. And to me, the good thing about what Basel is trying to do is that we have had very, very important associations just going against what they're trying to propose, right? And we have like the GFMA, which is the Global Financial Markets Association, just giving their view on why this regulation shouldn't be passed and shouldn't be approved. And at the end of the day, what we should always take into account is that always same assets will have same risks, right? And there's also something that needs to be taken into account, which is we need to be agnostic about the technology being used. And just by imposing this additional capital surcharge on permissionless networks, it's just breaking these concepts around technology agnostic. And it's also really, really important to understand why they're just bringing this concept around permissionless networks. And in reality, it's because of two important concepts. One is settlement finality, because they really want to understand that if you're doing something on a DLT, you need to be 100% in charge of the settlement and the finality. And for that, obviously, you have already touched base a little bit on that. There are already legal contracts in place to ensure that there's a finality associated to any transaction being on a DLT across different jurisdictions. And that's a lot of work that is being worked on as of now. And the other one is around being in control end-to-end of the settlement process. And that is obviously something that on a public permissionless network, you will never be in control, because the moment you are signing a transaction and you're sending that transaction to the blockchain, that's where you have all the validators, all the block proposers, block builders, making sure that the transaction gets inserted into a block, right? But there are many ways to argue this. And Martin has done a very comprehensive explanation of the different permissioning that can happen on a blockchain. But there's also the other side of the wall, which is, for example, on Ethereum, since the merge, there's a split on fees on how you can have a base fee which gets totally burned, and you have the priority fee that goes to validators. You can just set up priority fee equals 0, and you will ensure that your transaction, you're not putting any fee that goes to a validator in a sanctioned country, right? There are many ways to kind of like circumvent this. And what I'm really interested is to see how the industry is just pushing back into this prudential regulation and making sure that they understand that just pushing permissionless blockchains to be classified as group 2 is just hindering liquidity for tokenized securities, it's just hindering innovation, and it's just going in opposite directions to what other big institutions are doing, like the BIS, for example.
Yeah, thank you, Javier, for that. Yeah, please, Martin, go ahead.
Yeah, I
Just
I
briefly,
have
please.
one thing. I share your view that we should be technology agnostic and that we shouldn't differentiate between you know, like traditional Web2 technologies and distributed ledger technologies. I do think so. We need to hold blockchains accountable, though, for that promise. You know, like many like, you know, like decentralization, everything that blockchain stands for. Unfortunately, we see in many blockchains that this is not really the case, right? Like we see many layer 2s with centralized sequencers. No, imagine, you know, like you can control the sequence of transactions at, you know, like a major marketplace for financial products, right? Like that is a very powerful position in to be in. So even though transactions might be very cheap, you know, there's a secret tax where there's a real economy around some of these layer 2s that, you know, like sequence transactions front run their own users, which I think is terrible. So I think it's really important to look closely in the blockchain space and identify, you know, like what is, like, even though I love decentralized, like I really love decentralization, but really making sure that these chains that we issue assets on, that they are actually decentralized and that there's not a single party or a consortium that can front run their own users, that can control the sequencing. Yeah, I think, or there's no exit window for getting off a chain. That's also I think critical.
Okay, yeah, thanks for this. I think we covered now the IT perspective quite well. Let's now take a look at the distribution aspects, right? All of you mentioned it somehow. So currently, fund distribution is mainly done via banks, right? This is the most prominent distribution channel, but blockchain, of course, offers here the possibility, as we are talking about, as we are not talking about ETFs, that we can essentially create a blockchain-based platform, right, and distribute a fund unit from an issuer to an investor. And here the question for me is, what do you see, maybe short and then longer term, in the market? Because we've heard that the CSD should still play a role, even though from a regulatory perspective, one could get rid of him, see Germany, but also see the DLT pilot regime, which is already live, and we are expecting to see first DLT-based trading and settlement systems and multi-trading facilities hopefully later this year. But for me, the question is a bit, how can we solve this distribution puzzle a bit? Because currently it looks like we just see more island solutions, right? There's one blockchain-based platform here, maybe another there. Each of them might have some investors at the end, but the issuer, right, is really looking for an easy way to scale and distribute its funds unit potentially to new clients. So yeah, what is your expectation short and long term here? What can blockchain do and how will the market evolve? Happy to start with you, Simon, again.
Yeah, sure. So I think we expect the blockchain to be a settlement technology, and therefore we expect efficiencies as the main benefit of using blockchain technology, also for the fund shares, I think. However, to be honest, I think this will be different on the long term. And I'll try to give a reason. I think if you compare it, the initial use case of setting up the internet was to send letters digitally, much faster and cheaper, no envelopes. Efficiency case. This case paid off very well. We still send few letters only per mail today, but most of them by email. However, this was not the large-scale application of the technology, even though it's also a backbone technology, right? It's protocol for communication. So it's clearly something also in the backbone of technology, not in the front end. I think it's here similarly. So when we look at the fund shares, for me, it's the individualization, also the distribution part that can be much more, let's say, like individualized, also more specific, yeah. And then also the risk management, not to forget, because we'll get a much better data view of funds, of their distribution, of their risk attributes. And this makes it on the long term much better. So I think less structural risk, higher possibilities for individualization, and then also the possibility of direct distribution on the long term in this combination also will be much bigger triggers for the evolution, but also the adoption of crypto fund shares to me.
Thank you. Javier, you maybe next. Anything to add here?
Yes, I just want to add something that I believe it's a problem that not just fund shares or tokenized fund shares are having, but any tokenized security is currently facing in the European Union, which is, at the end of the day, we're trying to use the technology that is very efficient as a settlement ledger, because we always try to say that we can settle trades in real time, like atomic transactions. But the real issue that we're having today is that we don't have cash on the ledger, right? That's one of the biggest issues that we have as an industry. There are many kind of like different ways of ensuring that you can have cash on the ledger to ensure that your tokenized fund share is exchanged for tokenized cash. But the different use cases that we have seen so far are all of them not scalable. That's why we have seen right now the ECB kind of like trying to promote a solution for wholesale CBDC. We're also seeing many of the banks trying to accommodate into MiCA and issue e-money tokens or stable coins. That's how the name that we're putting here in the European Union. So I really believe the first bit that we need to solve as an industry is how do we ensure that we have real money on the ledger to facilitate the exchange of these fund shares and also to really benefit from having a product tokenized on the ledger. And within this aspect, just because you mentioned before the pilot regime, this is one of the conclusions that ESMA just released a couple of weeks ago. The DLT pilot regime is not getting such a big traction just because there are no solutions to tokenize cash on the ledger. And there are many reasons because of that. Because, for example, for ESMA and the pilot regime, they're saying that only credit institutions can do so, and they don't accept the ones from electronic money institutions. So regulation is trying to get us to the point, but I really believe that we really need more time to ensure that all the regulations that we have here in the European Union with MiCA, with the different pilots happening, etc., need to converge into a point where we really have something that is usable at the ledger level. And this could be a solution where we have money on the ledger, or where we have a bridge, or we have a interoperable solution between traditional payment rails like Target 2, right, or RTGS, TIPS. We already have real-time settlement systems in the European Union, and connecting these systems with blockchains. And that's where that interoperability is going to help to kind of like ensure that all the benefits, all the efficiency gains that we promote about this technology are gonna be real. And then the second part is all these POCs that are happening right now by testing. How can I use prices on the ledger? How can I automate with smart contracts rebalancing? How can I automate with smart contracts and ensure that the investors are applied specific tax regulations based on their jurisdiction? So all those things are coming, but I think that we really need more entities and more pilots just testing all of this and making sure that we get to the point where we can say, and we can really say, that tokenized fund shares are bringing X amount of basis points reductions in fees because it's a really efficient market.
Thanks, Javier. I mean, you all covered also already the part around efficiency gains, right? There are certain limitations we see. One of them surely is that we somehow need digital money to also have a solution for the cash lag. This is clear. And we are almost through today, which would bring me to my last questions, where we should try to make it brief again. And given all that we discussed, and we see the activities, we see limitations, what is your personal opinion for really short term? For me, this would be 2024 and next year. Will we see more tokenized fund units there, or is it really we need a trigger in terms of we need digital money somehow, digital cash solution, that we will see a broader adoption of investment fund tokenization? So the question really is, this year and next year, will the market remain as it is currently? So maybe a proof of concept here, maybe this closed garden approach that we mentioned earlier, or is there something already in the next 2 years which will bring to life more tokenization of fund units? Martin, happy if you go first.
Yeah. I don't want to do a prognosis of what's going to happen in the European market because I'm not too familiar with it, but let me just say I think it's a huge opportunity, right? Like there's a huge opportunity. Regulation in the US is lagging, and it's taking us a long time. Singapore is moving very, very quickly. So I think we are in a unique position that we have a very strong financial market, and if we do the right steps now, as an industry and as a society, there will be huge opportunities to be one of the first movers in the space.
Okay, Javier, what's your take for the next 1.5, 2 years?
So I really believe we're going to start seeing the industry moving for fund shares. And to me, the clear sign that I always have is looking back, what was the most used tokenized project in 2023? They were all banks issuing bonds. And probably from Q3, Q4, we have really started to see a pretty clear movement into private markets. And that's where we have all these big asset managers getting involved. We have even seen BlackRock just doing something in a public permissionless network. So I really believe we are just moving into the right direction, and we will be seeing something end of this year, probably start of next year, that will be very interesting for the industry.
Okay. And lastly, Simon, to you, how many billions of issuances are in the pipeline?
So I'm thinking about what are the digits after the comma compared for this number than for the Bitcoin. For Bitcoin, I know it's 7. For this one, I'm not sure. Yeah, but to be honest, I think if I compare it to the life cycle and development of other assets that we've seen in the blockchain, I would still say that we are really, really early on the fund share side. So to be fair, in the next 1.5 and 2 years, I don't expect too much, without trying not to be pessimistic, but it simply really takes time. So there might be like the one-off large transaction. We have done that before as well in the security space. So this might happen, but it's not really what we define under adoption. And I think adoption follows natural growth, and natural growth is mostly not linear, but exponential. And exponential means for a very, very long time, the curve is very flat. And to be honest, I think so as well for the crypto fund shares. Yeah. However, what I think is good and necessary is that you see that people are committing resources, yeah, on this topic to develop it. And this is clearly obvious already. And so if we see that in the next 1.5 or 2 years, also still large corporates like BlackRock has done will stick to it and put money and smart brains into it, then I'm really looking forward to a big market with billions under registry or management in 10 years for sure.
Okay, perfect. Then, Simon, thank you for these closing words, and thanks to all the participants who watched this online panel on fund tokenization. Thank you for tuning in, and all of you have a great day. Thank you, Simon. Thank you, Javier and Martin. Take care.
Thanks to you, Benjamin.
Thank you, everyone.
Yeah.
Bye-bye.